Hello. Right, good afternoon, everybody. Thanks for being in today's session. Hopefully, the sound's coming through loud and clear and you can hear me okay. If you can, please do let me know. Now, look, we are streaming on GoToWebinar as usual today, but also we're up there on Facebook and YouTube and a few other places out there in the world. And today we're going to be talking about how to trade news and events. I'm hoping to probably take about 35 minutes to go through today's session. Questions are always good in these sessions, so please make sure you ask questions as we go through everything. And in order to do that, there's some instructions that are on screen. So if you are on, where they've gone, they seem to have disappeared. Bear with me. So there's some instructions there. Let me just quickly bring my pen in. If you're on a tablet or smartphone on the GoToWebinar program, it's going to look something like this with a question mark at the bottom there. Hit that and the keyboard will pop up. You can type something in there. If you're on a laptop, desktop computer, again using GoToWebinar, you've got an orange button. You may just see this very small little panel floating around somewhere. Hit the orange button and then you'll be able to type into the questions section there because it maximizes the control panel. If you're on Facebook and watching us on YouTube and LinkedIn and various other places, the interaction is going to be a little bit more tricky because there's lots of different places to access all of it. But I'm going to focus on the GoToWebinar questions if that's okay. Camo, hello to you. Good to know we're all coming through crystal clear. That's great. Andrew, will this session be on the message board to watch later? No, it won't, but it will be on our YouTube channel and Facebook channels and so on. So this is a session. It's not a workshop per se, Andrew. So it's not something that's specifically tailored to Trendsignal customers, those who've already joined our programs. This is really, open information that we're happy to sort of provide out there for anybody that is interested in trading and just to understand a little bit more about some of the ways in which best practice might be. Today is going to be talking about news and events. We're going to be looking at this from both perspectives, but probably a little bit more from a day trading perspective. Day traders, short-term traders looking to get in and out of the markets quite quickly, rather than perhaps from an end-of-day perspective. But we will ask and we will go through how it can be applied for more end-of-day or swing traders as well. Because I appreciate there'll be a number of swing traders in today's session also. Okie smoky. Before we do get into it, just going to read the top two paragraphs of this if you don't mind. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Past performance is not a reliable indicator of future results. This presentation has been prepared without regard to your investment objectives or financial situation. All opinions, news, research, analyses, prices, and other information herein are intended as general information only and are provided on the understanding that Trendsignal is not rendering investment, legal, or tax advice. Whew, okay, let's move on then, shall we? I know we all know all of that stuff anyway. The thing about trading for me is a lot of it's about rules, and the rules are great. But a lot of the rules is, and the problem with rules is, they're only great once you know what they are. And if you're brand new to something, what's common sense to an experienced trader isn't common sense to a brand new trader because they just don't know yet, and that's fine. Much like if I was to walk into your places of work, I dare say I wouldn't have a clue, and stuff that you think is pretty straightforward, I probably wouldn't have a clue about either. And that's fine, and that's absolutely okay. That's the purpose of doing these sessions, is to help share some of the experiences, some of the things that have really helped us over the years, so that perhaps you don't have the same mistakes that we might have had 5, 10, 20 years ago. So the thing about it is, listen to what we're going to go through today. This is pretty important, particularly if you are going to be a day trader. A lot of it really comes down to just stopping and taking a bit of a breath, because when it comes to trading, when it comes to looking at news and analysis that comes out, so news releases, could be corporate earnings as well, Rafid, it can be a little bit of a fruit machine. Okay, so that's the purpose of this slide, is to really to demonstrate that if we're looking to trade over news and important events, or scheduled events, it can be very much a gamble. And whilst you could say, well, a gamble is 50-50 worst case, it really isn't 50-50 because of something called gapping and something called slippage. Now, we're going to go through what that basically is today. The good thing about news and events is, however, if you're sitting there thinking, well, that all sounds a little bit sort of grim and a bit scary, you don't have to worry about it in the majority of cases, because we know when news and events are going to be released. So we know that they're scheduled at a certain date, a certain time, and we can plan accordingly. So the better planned and prepared you are as a trader, the more you can look to manage the risk that you may face as a trader. So those that don't look at, for example, an economic calendar, if they're going to be day trading, well, to be honest with you, they're going to have a few problems. Okay, if you have a look at a calendar, if you know where you are, where you're at, what the sort of the banana skins and are throughout the day, then you can really look to take risk off the table. And that's the same thing with stocks, Rafid. So if you're looking at corporate earnings as a stock trader, that can be very important as well. Less so if you're going to trade Forex or indices and commodities. To a certain extent, indices maybe, but they are kind of a little bit more desensitized to an individual company's corporate earnings, but they could still well be a factor. Okay, so let's just have a quick look. First of all, we're going to talk about the different types of news and events in just a second. What I want to talk about is why they are important and what impact news and events can actually have on the markets. And then we can talk about what we can then do about it. All right, so when it comes to trading news and events, for me, it's a case of be in the market before the news, make a conscious decision whether to hold that trade over the news, but probably best closing it, and then make a decision to enter the markets after. What you'll find is, let's take some important economic data like CPI, some inflationary data, which is, I think, coming out later today in the US. Do we want to be trading the Dow or pound against the dollar or euro against the dollar coming into a major piece of economic data? No, we don't. And the reasons why I'm going to share with you in just a second. And do we want to trade those markets after the data is released? Well, probably yes, because the thing about news and events is it creates, they're market stimulating events. They would create movement. Movement is a trader's best friend. Volatility is a trader's best friend because movement creates opportunity. The more movement there is, the more potential for profit there is, assuming, of course, we can manage it and trade it in the right way. So, what I would say to you is this: the best traders out there are the ones that manage and look out for the problems, and economic data can be one of those. It's a little bit like if you're going to be a golfer. What are you going to do when you get to the tee? A bad golfer, an inexperienced golfer, perhaps I should say, as soon as he gets the tee, he's already pulled out his driver and he's just going to try and smash it as far as he can down the middle, right? A more experienced golfer, someone who's looking at the risks and doesn't want a double or a triple bogey or whatever, he's going to think about, well, where's the best place to hit this ball? What's going to give me the best opportunity for a birdie? And what's going to give me the reduced opportunity of making a bad score? So I need to think about water. I need to think about out of bounds. I need to think about bunkers, all that sort of stuff. I need to try and place my ball accordingly. And traders should be thinking about things in the same way. Okay, so gapping and slippage. This is the most important element of this. So yes or no in the questions box, do we know what slippage is? Let me know with a yes or a no. Do you know what slippage is? I imagine a lot of you probably know, a little bit more likely know what gapping is, but do we know what slippage is? Yes or no, please. Okay, a few yeses coming through. There are a couple of no's. It basically works like this. Slippage is basically something that can happen with a market order. Now, a stop loss is a form of a market order. It's triggered as the price gets to a certain level that you set, and then a market order is then triggered. So what happens is the broker will then look to close you at the first available price. Same thing with a market order. If you're trying to get in right now at the market, sometimes you may find that the price you get filled at perhaps wasn't the price you're expecting. Has anyone ever noticed that? So when you're looking to buy at, say, 100, And actually, you notice, actually, I got filled at 101 or 100 and a half or something like that. That wasn't what I thought. Why did that happen? And sometimes you might notice that on a stop loss as well. You ever seen that? So you're trying to put a stop loss in at, say, 90, you're long, stop loss in at 90, and then suddenly you get filled at 89 and a half or 89. Um, what's that about? My order is at 90. Well, what you've got to remember is that the market is simply a market. If you're going to enter a trade or buy a market, you have to buy it from somebody else. So if you want to buy shares in Vodafone, you are buying shares from somebody else who is selling Vodafone shares. You want to buy euros against the US dollar, you're buying euros with your dollars, but somebody is selling euros. So, you're going to be giving them your dollars. There has to be someone on the other side of that transaction. In a very fast moving market, the price at which you see in the market may not be available because the market is moving faster than your eyes can actually see. And that can happen over things like corporate earnings, major economic data announcements can create very fast moving markets. So what you're looking for the price you want to get, it could well be in a very brief period of time, nobody wants to pay that price anymore. And it may have already moved a little bit too fast for it. Now, that doesn't happen all the time, but it can happen. And it's more likely to happen over economic data. Okay, and I'm going to explain a little bit about how the market works in just a second. Okay, the good thing about it is that we can manage this. Now, if I look at this chart here on the left-hand side, you've got a market. This is a very old chart. It doesn't actually matter. But you've got a market that's starting to turn higher here. And it could be that that's an opportunity to buy. This is a 15-minute chart, right? You might be thinking, oh, okay, that's starting to turn higher. I might want to buy this market to go and see about some rising prices. That sounds pretty interesting. It's at 9:30 and we're looking at the pound against the US dollar. Now, at 9:30 on that particular day, we had some important economic data being announced. We had in the UK claimant count change, so that's for unemployment data, but more importantly, we had the meeting minutes for the Monetary Policy Committee. This is to do with the interest rate setting body in the UK. So they're releasing the information that they were discussing in their last meeting. That's massively important for the pound and for the FTSE 100. And so this is something that basically says, look, this movement up to 9:30 is based on what we know up to that point. At 9:30, some new information is going to come to light that will suddenly make us think, oh God, maybe the pound shouldn't be valued at 154.35 anymore because we're more likely, it seems, to cut rates than we thought. We're more likely to increase interest rates than we thought. So therefore, you can have a big impact on prices. So as economic data is released, particularly the higher impact stuff, it's more likely to have a big impact on the price. Okay, the more important the data, the more the more far away the data is released away from the expectations, i.e., we're expecting 100,000 jobs created, but it only came in at 1,000 jobs, whatever it is, that can have a big impact on price. The point basically is this: these big market stimulating events or movement stimulating events can create a big impact on price and therefore on slippage, which is what makes it a negative thing and something that needs to be managed. Okay, so, and remember, when it comes to gapping, when it comes to slippage, you can only be matched with an available buyer or seller. Okay, so you're only going to get the price you want if somebody is prepared to buy or sell at the price that you want, right? So what happens here is that, let's say that you were in a trade. And just to give you an idea about the I guess the negative side before we know what to do about it, let's say you bought here, and let's say you put a stop loss in down here, I don't know, whatever, at 154.20. That's where your stop loss is going to be. And you thought, you know what, sod it, I'm going to go for it. It's 9:30 in the morning. I don't know anything about economic data because I haven't looked it up. Of course, that wouldn't be part of the thought process on that basis. But anyway, I'm going to put my stop in at 154.20, and we'll see what happens. Economic data comes in. There was my buy. This is the next candlestick, and whoosh, down the market goes. There was my stop loss at 154.20. Now, the question is, am I more likely to be closed out of that trade at approximately A at 154.20, or given the speed of movement, am I more likely to be closed out down towards B? What do you think? Give me an A or a B. So where am I more likely to be closed out of that trade? So my stop loss at 154.20 is to be closed on a best endeavors basis. So assuming I'm going to be selling there, assuming somebody wants to buy at 154.20, I'm going to be able to close my trade at my stop loss at 154.20. Okay, so what do we think? If the market's moving super quick, where am I more likely to be matched? At price A or at price B? Really, the answer is it could be anywhere in between. Okay, so what happens is when the price goes down to your stop loss, an order is triggered to say, right, now find me a buyer to close me out of this trade. I want to sell my pound against the US dollar position, find me a buyer. And if the price is falling that fast that nobody wants to buy up at 154.20 anymore, then you're going to have to then go down and down and down and down and down and down and down. Now the broker will take care of that all for you, but it could be over a super fast moving market. Could be you get filled down at this 153.40 level. That's what 80 pips lower than we were hoping to exit the trade at. So really, Andrew, yes, you're right. Andrew D, could be anywhere in between. The point is, over a fast-moving market, it is less likely that you'll be closed out at your stop loss price, and it is more likely you'll be closed out at a price that is away from that stop loss price, therefore incurring a larger loss. Does this all make sense, everybody? Give us a quick yes or a no. Just want to make sure we're all on the right page. Yeah? And why is that the case? And don't worry if this all sounds a little bit scary, it doesn't need to be. The reason this happens, by the way, is because of what's called the market depth. Now, the market is made up of buyers and sellers all over the world, right? And that creates a price. So that price is made up of, on this left side here, we've got a series of, this is like what's called a super dome or super depth of market. You can look at level 2 data. There's a number of ways of analyzing this. Whatever it is, whatever price that's lower than the current price at the moment, there are traders who are looking to buy a certain number of contracts or CFDs or shares at lower prices. And in order for the price to fall and go down, then people have to sell into those in order to drive the prices lower. They're just being matched with buyers and sellers. And again, equally, in order for the prices to rise, then the price has to trade through all of these sellers all the way up here at these higher prices. It's called the depth of market, which is basically a snapshot at any given time of what the buyers and sellers are in the marketplace and what price they're hoping to buy at and what price they're hoping to sell at. That amalgamation creates the current market price, which your broker will then mirror on the platform on which you're trading. This is what I call like a normal order book, okay? Now, when the market is coming with economic data, it represents risk. So all those pension funds and hedge funds of this world, they're not going to sit there with the same orders in place when the market's about to come up with something that they don't know. So when new information comes to light, they're like, oh, okay, well, I've got these orders working at the moment on pound against the US dollar. Do you know what? Actually, I'd rather cancel those for now. Why don't we see what the economic data comes out like, and then I'll put some new orders on and trade from there. At least that way, I know what's happening, I know what the information's been released at, and then I can reposition my portfolio accordingly. So what happens is, as you come into economic data, lots of traders around the world are going to start to, and these are the ones that make the market, you understand, the pension funds, the hedge funds, the professional traders, they're going to start cancelling their orders. Why? Because it reduces their risk. It is the appropriate thing to do. What that means is that you can get gaps between prices. That's why over economic data, you'll see prices jump quite quickly. It's not always the case that there's a huge amount of trading. It just means that there's what's called a very thin order book. It's a little bit like a marketplace of millions of people participating, as opposed to a marketplace of 2 or 3 people participating. So, there's not as much activity and prices can jump very quickly. That gapping, that fast nature in the way in which markets move can lead to much bigger candlesticks, okay, which can in turn lead to slippage. All right. So hopefully this makes good sense. And remember, if you're a day trader, this is quite important. If you're a swing trader or an end of day trader trading off daily charts, this is much less important to you. But hopefully that is all making good sense. Remember, it is simply about a marketplace. So the question then comes in as to what can we do about it? So slippage can be an issue, but we can manage that slippage just much like a golfer can manage where the water is and where a bunker is and where out of bounds is and so on. And if you don't play golf, you have no idea what I'm talking about, I apologize. When it comes to news and events, then we can know what these are. And I'm going to talk about what impact they have on the markets a little bit later on and how we can benefit from it as well. So it's not just about a horror story, it's about what we can do for benefit. So let's think about major events that are out there. Interest rates, unemployment data, GDP, inflation, and so on, sales data. This is all important stuff. Corporate results, so corporate earnings can be important if you want to trade stocks. All of this information has the ability to move markets. How do we access this information? Well, one of the links that I would encourage people to have a look at is Forex Factory. Now, I've kept it kind of simple at this point just to go to the main site, so forexfactory.com. And what I'm going to do is go to the calendar here. Now, on that calendar, I can notice a number of things. I can see here basically all the economic data events that are coming out for that particular week. So we've got yesterday, we've got today there, the 17th of January, and so on. So if I zoom in on that, I've got all sorts, loads of different events that are coming out here. Now, a lot of this stuff isn't so important, okay? So some economic data items are going to be more important than others. So what are the most important items? Well, one of the clever things that a Forex Factory does for us, and a number do, is they rate the likely impact that this data is going to have. So the yellow, quite low impact data. So they're not going to have a huge amount of impact on the markets. Then you have the amber ones, and then the red ones are the most important. So a nice filter that you can do, by the way, what's going on here? A little filter that you can do is you can select to remove those yellow ones. You can apply that filter. You could even, what's happening here? What have I done? I've pressed the wrong button, I think. So on calendar, if I wanted to remove the yellow ones, then I can do that. Then I'm suddenly looking at a much smaller list of items that are more relevant to us as a trader. So what can I see for today? I can see that in China, we had their GDP data, their growth data. In the UK at 7 a.m., we had our claimant count change data. Ironically, the same as on that slide from however many years ago, it doesn't matter. CPI, inflationary data in Canada, so it's going to have a biggest impact on the Canadian dollar. And also we've got Empire State manufacturing data in the US. Okay, so these are all deemed to be important items of data. So as a day trader, we need to be relatively aware about what these are going on. So if I was day trading the Canadian dollar today, which I'm not going to be, but if I was, then 130 would be a pretty important time. If I was going to day trade the Dow, the S&P 500, if I was going to day trade euro against the US dollar, then 130 would also be an important time because we've got this manufacturing data coming out. Now, what's important as a day trader is not so much about what it is, what the impact's going to be. You just need to know that they're coming out. So the point I'd say from this is you do not need to be an economics whiz kid in order to know how to trade news and events. All you really need to know is that something important is happening at 1:30, and therefore, should you be in a short-term day trade where you're looking at the position for maybe half an hour to an hour, should you be in that trade over at 1:30? No, not unless you intended to and you did so knowingly that economic data is coming out. But even then, it's a very risky play because you're more likely to experience slippage, and slippage really puts the odds against you. So if it's 50-50, it's not 50-50 because of slippage, you're more likely to lose money on it. Okay, so whatever money you make is probably going to be overcooked by the potential risk of slippage on the stop loss. So just be a little bit mindful of that. But what it tells us is what we need to be mindful of, right? So if you are going to start as a day trader, starting out the day, what are the most important items? Well, 7 o'clock, well, maybe you don't start till after 7, so that's not really a problem anyway. You've got some euro data, which is important at 10 o'clock this morning that's already come out. And I don't trade the Canadian dollar for day trading, but 130 for US, that's pretty important. So I need to be pencil sharp and I need to be closing my trades out ahead of that. You could set a little alarm if you wanted to, whatever it is that's going to help you. As a swing trader, you don't need to be worried about these items really. They're not that big a deal. But they are when you're trading the micro time frames. Is this all making sense there, everybody? Let me know. So we've got all sorts of data in here. All we need to say at this point is, like I said, just be aware of what they are, when they're coming out. That's all you really need to know. Now, as a swing trader, what should I be aware of? Well, let's have a think about that. The most important items of data are going to be to do with interest rates. What's happened here? I do find the Office 365 version of Microsoft just annoying. Anyway, bear with me. Okay. So what are the most important items of data? You've got inflation and growth and sales. They're important, right? You know, they're going to be red items, particularly if it's to do with the US. Okay, they're going to be red items on your calendar. Day traders need to be aware of those. Inflation is particularly important at the moment because we're in a bit of an inflation crisis, but it isn't normally so important. It's pretty important, but it's not like, be that careful about it. The most important items are interest rate data and unemployment data. American, US unemployment data. These are the things that particular swing traders, it helps if we're aware of, particularly if you're trading foreign exchange and so on. Now, why are those more important than the others? Let's give you a little tip really on this. Currencies will move based on the impact of or any potential change to interest rates. So pretty much every economic data announcement that occurs, the result on the market will be based on what does that mean to interest rates for that currency. So for example, if you've got some data that's coming out for, I don't know, UK inflation data, the impact on the pound will be based on what does that data mean to UK interest rates, okay? Does that release of inflation data in the UK, CPI data, PPI, RPI, whatever, is that mean we're now more likely to raise interest rates or less likely to raise interest rates, or more likely to cut interest rates or less likely to cut interest rates? Ultimately, whatever data is announced, it all comes down to, are we now more likely than we thought or less likely than we thought to make changes to interest rates? That then creates the movement in the pound. Now, why is it all about interest rates? It really comes down to this. If the economy is doing better than we expected, then it is more likely that the economy needs to be slowed down than it did before. And if the economy is more likely to need to be slowed down than before, how do you slow an economy down with interest rates? Well, what you do is you encourage or you reward saving and you penalize spending. So how do you do that? Well, what you do is you raise interest rates. If you're more likely to slow the economy down, which because the economy is doing better than we thought probably, or inflation's higher than we thought, growth is higher than we thought, sales are higher than we thought, then we're more likely to increase interest rates. Okay, so why is that? Because that means we're more likely to save more, which means we're more likely to spend less. It also means that our mortgage payments are more likely to be more expensive in the future than we originally thought, which again means we've got less money to spend because we're going to be spending more money on our mortgages or more money on our loans, which means we've got less money to spend on the high street. That will slow the economy down and so on. So the stronger the growth data is versus expectations, expectations, the stronger the inflation data is versus expectations, the stronger the sales data is versus expectations, the more likely it is that interest rates are more likely to rise than they were before, which means that what with currencies? It means that actually, if interest rates are more likely to increase, it means that that currency is now more attractive than it was before. Okay, so the pound, for example, if we're now more likely to raise rates, let's say we're going to go from more likely to go from, I don't know, 3% to 3.5% or 3.5% to 4%. Oh, that makes the pound more attractive because actually investors can get a better rate in the pound now probably than we thought we could before. So what that means is that the pound is likely to go up in value. Okay, so all other things being equal, if growth data, GDP data, inflation data, sales data is better than expected, it means that interest rates are more likely to rise, which makes the pound more likely to rise because it makes it more attractive for investors. Okay, because yeah, well, they're going to go wherever there's a better rate of return, right? So you can hold their money in different currencies, but they're more likely to switch it into pounds because they can get a better rate of return from the banks and the bonds and so on. Okay, that's basically how it all works. Currencies will move based on the perceived change to interest rates. Okay, does that make sense, everybody? Give us a quick yes or no in that questions box. All right, now how does that help us to make money? It doesn't really, but it's kind of useful to know. All right, so if you see then sales data is not very good, let's say we're expecting sales data of Y, and it comes in at half Y, you're thinking, oh God, okay, so actually that means that the economy is probably not doing all that well because the sales data is pretty low. People are not buying as much. Why is that? Because they don't feel so confident. That feels we're probably a little bit more like a recession than we were before, which means we're going to be more likely to need to stimulate the economy than we did before. How do you stimulate the economy? Well, you're more likely to need to cut rates than we did before. So that new economic data creates information for us that we can then digest and deal with. So actually, if sales data is lower than expected, we're more likely to cut interest rates than before to stimulate more spending to prevent us from saving as much. That then means that the pound is more likely to fall. Okay, so that's generally the way it all works. It's a pretty simple rule. No matter what the data is, what is the likely impact on interest rates? That's it. That's all it really comes down to. Okay. Now, why is that important for us as traders? As swing traders, it's important because if you worried about every single piece of economic data that came out every week, you'd never do anything, right? You'd be paralyzed constantly because there's so much economic data that comes out every week, and you don't have to worry about it really. The most important things that you might want to think about are interest rates and, in America, unemployment. And the reason for this is that there are generally one mandate that a central bank has to fulfill, and that is to control inflation, to control prices. However, in America, they have two primary mandates. One is to control inflation, and the second is to foster full employment. So that is why non-farm employment change, or non-farm payroll, it's called, which is typically the first Friday of each month, is extremely important item of data as well. So what that means is that can have a very big impact on price movement and slippage and gapping and so on. So for day traders, do you want to be in the market as non-farm employment change is released? No, you really don't. Do you want to be trading the aftermath and the riptide, the waves that happen thereafter? Yes, you absolutely do. It's a very attractive time to trade because the market is more likely to create movement and speed and therefore opportunity. And so, understanding that as a swing trader, what do I say to swing traders? Well, look, if you've got 4 yen trades on and you've got the Bank of Japan reporting their interest rate data tomorrow, you might want to think about reducing your risk a little bit. You could close all the trades, you could close some of them, you could close, half of each of them, whatever, but you might want to think about the risk that represents. If you've got a number of dollar positions open and you've got FOMC data or you've got non-farm payroll data coming up on that particular Friday, first Friday of the month, you've got $4 or $5 positions on and you're long the Dow, you might want to think about reducing the risk. Okay, it's a pretty simple thing to do. It's a pragmatic thing to do. Much like as a golfer, you've got water, you've got out of bounds, you've got bunkers, you've got a really tight, narrow fairway. Are you going to rock up with your driver and try and smash it as much as you can? Of course you're not. What you're going to do is probably just knob an iron down there, or a utility club or something like that, a hybrid. You're going to take some of that risk out of play, and it's the sensible thing to do. Okay, because you're just going to take some of that risk out of play. Because actually, what's the point of all of that risk? Keep some on, maybe, for sure, but maybe it's a pragmatic thing to do is just to reduce a little bit of it. Okay. Again, everybody, is this making sense still? You still with me? Give us a quick yes or a no in the questions box. Okay. Now, in terms of, let's just quickly go to the calendar just so we can have a little look at that. Where are we? So important data items. Actually, curiously, we actually do have the Bank of Japan interest rate data tomorrow. Okay, so actually, if you've got 4 or 5 yen pairs open, I know for Trendsignal Plus, for the D1 Sniper strategy, we've got a couple of yen pairs open tonight. Should we be thinking about reducing risk and closing those out? It's probably not a bad idea, actually. Because it's a pretty important item of data that's coming out there. All right, so it could create a big reversal in the market. If I was going to be day trading the Dow at 1:30 tomorrow, what am I going to be concerned about? I'm going to be worried about PPI and retail sales data because they're likely to create big movement. And to be honest, I'd rather not. This is what I really wanted to show you today. So what I'm going to do is go back and have a look at some of this high impact data. Now, yesterday was Martin Luther King Day. It was a bank holiday in the States. Nothing really great deal I can show you. However, if I go back to last week, let's have a look at the most recent sort of major economic data we had. So last week on the Thursday, the 12th, we had CPI, Consumer Price Index, inflation data, pretty important, okay? And actually the data came in bang on expectations. The quick thing is that data at 1:30 there, quite why we've now moved to non-UK time. Let's just change that. We go back to where I was. There's a few gremlins in this system today, it would seem. What do we have? We've got at 1:30 on Thursday, the 12th of January, we had consumer price index data. That's important information. So what would we do as a day trader? If you're going to be a short-term day trader, well, let's go back and see what actually happened and we can talk about it. All right. So what am I looking at here? Just bear with me. Let's just go back to that time point. Okay. So 1:30, that was the time. That's the 128 bar. That's the 1:30 bar. So as that data came out, look at what's happening here. Small candlesticks, the marketing ratcheting its way here, and then wham, the data was bang on expectations. However, the stock market, the Dow, had a range of what? 34,200 down to 33,750. That is a 450 point range in 2 minutes. 4 minutes, sorry. Had a 450 point range in 4 minutes. Okay, why? Because that order book suddenly went really thin and it's the price flying around, wanging around like anybody's business. Okay, should we be worried about this data for swing traders? No, not to a lesser extent. Day traders, should you be closing out of the trade at that point if you're long or short? Absolutely. You should be out of this trade. Should you trade on that sell trade there? Yeah, you can do. Anything after that data is released is all good. There's great opportunity. There's great potential trading to be had. There was a buy trade here, for example, using the dynamic trader strategy, and then the market rallied 60 points within 2 minutes. What happens is that these events create movement. Now, I don't care whether data, obviously I do from an economic and social standpoint. I'm interested in whether the economy is doing better or worse. As a trader's perspective, I don't actually care. All that I really care about is that something's happening. Okay, I don't even really try and interpret it too much and think that data's better, because I'm not a fundamental trader. I don't really care. What I do care about is the impact that it has on prices. If I just tighten this chart out, what I want you to think about and look at here is this band here. How to trade news and events really comes down to where is opportunity. Opportunity up to 130 is pretty narrow. If you think about how much movement is happening here, this is like a real small amount of little ebb and flow that's taking place. The market's moving up 10, 15 points in a really sort of blur, meh kind of way. 130 kicks in. Suddenly, inflation data comes out. Pension funds, hedge funds, they're repositioning their portfolios. They're like, oh my God, that data's come out. What am I going to do with it? Okay, I've got too much risk in. I need to close this. I need to open that. I need to do this, that, and the other. I need to do lots and lots of trading in order to manage my risk appropriately again. This creates movement. Okay, so this economic data announcement has a massive impact on prices, a little bit like a wave. It's going to happen like this. And then the waves, the ripples will slowly settle down. But the next couple of hours, particularly if that data is really important and the announcement is far away from expectations, those waves, those ripples of those waves is going to be bigger, which means that we have more opportunity. The more higher impact the item of data, the more away from expectations it is, the higher impact on prices it will have, and the more attractive it can be then to trade the aftermath. Okay, that's how you can see it. You look at the channel, suddenly you're looking at a pullback there of about 20 points. Here, look at that pullback there, suddenly 400 points. This is happening constantly. And it's about an understanding of when those news and events are happening. You don't even have to know what CPI stands for. All you need to know is that it is coming out. And that is likely to create a market movement stimulating event, which could be pretty interesting to trade. That's it. That's all you really need to know. All right. Again, guys, are you still with me? Hopefully I haven't bored you to tears with economic data, because actually you don't need to know. I did an economics degree, okay, and that was, I graduated in 2001, a horribly long time. Do I use this information? Yeah, it's kind of nice to know anecdotally, and it means I can tell you about, oh, sales data higher than expected, which means we're more likely to raise interest rates and blah, 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 blah. Does this actually help me make money as a trader? Not really. All that I really need to know is on the calendar. Because if it tells me that it's a high impact item, then as a day trader, I know I pretty much need to be at my desk. I don't want to be in a trade at 130 as a day trader. I want to be in a trade at 132, 134, 136, because that's when I'm going to be picking up the movement. Okay. So hopefully that's coming through loud and clear. As a swing trader, what do I do about this? I simply look at it a bit more pragmatically again, that, well, I can't worry about all the data because there's always something coming out. Interest rates, they're going to be important. So if I'm trading yen pairs and I've got yen in Japan, Bank of Japan, I've got interest rates there coming through, then I need to be concerned about that. But otherwise, I'm not so bothered. Okay. That's generally how it all works. So you'll notice here as we come through to the last week of January, the first week of February there, as we scroll down here, you've got here non-farm employment change. That's one of the most important items. Day traders will be sharpening their pencils and so on. Would I be trading into 130? Absolutely not. Would I be trading after 130? Absolutely yes. Because what we see here, this bigger increase in movement, is actually going to be more pronounced, I would expect, on the 2nd of February than it is here. Potentially greater opportunity and so on. And the reason for that is because it's a more important item of data, and especially if the item comes further away from expectations. The more away from expectations an item of data is, the more impact it's likely to have on the market, because it means the more a pension fund and a hedge fund has to reposition its portfolio. Because if an item of data comes out that's bang on what we expected it to be, then they're already positioned for what they expected it to be. They've already got this weighting of stocks, that weighting of bonds, blah, 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 of this currency, that currency, and the other. So when something comes in at expectations, great, I've already planned for that. That's fine, that's cool. You don't expect a huge amount of movement in the medium term, all right? You might have a big ripple of speed, but you'd expect the markets to not really do a whole heap over the next couple of hours or beyond. When markets come in way away from expectations, that can stimulate trend change and so on. But, again, we don't have to worry about it all too much. So that's really it. market stimulating events that really, as traders, we simply need to know where the banana skins are. Where's the outer bounds? Where are the bunkers? Where's the water hazards? Where are the banana skins we're about to step on? If you can work that out, then you're taking a significant amount of risk off the table. And when it comes to trading again, I'm going to bore people with golf analogies because it's my game. But when it comes to golf, the way in which you become a better golfer is not by playing more good shots, it's by playing fewer bad shots. The more you concentrate on eliminating double and triple bogeys, your score will naturally become better. That's really all that it is. Why am I talking about golf when I'm supposed to be talking about trading? Because it's the same thing. The more you can reduce the likelihood of loss-making trades and risk, the more the winners will look after themselves. It actually is that straightforward. Okay, so I would encourage you to have a look at that. And one of the things, if you are already a Trendsignal Plus trader and you're a swing trader, what would you want to think about? Have a quick look at the calendars. One of the reasons we talk about it in our Monday workshops, be aware about what the major events are. We've got a couple of yen trades open at the moment. I think it's Aussie yen and pound yen on the D1 sniper strategy. You might want to think about reducing risk. Now, that will be a discretionary play. The rules of the strategy would simply be to run it accordingly to the stop, target, and active stop. However, if you wanted to take your trading to the next stage and introduce an element of risk management that's beyond those base rules, then that's very easy to do just by looking at the economic calendar, which would help you to reduce risk from your trading, which really has got to be a positive and quite a natural progression from looking at the base rules of the strategies that we teach here. Okay. So hopefully that makes pretty good sense, everybody, today. There is one more thing that I wanted to cover off on. And I know you guys have been pretty quiet today, but hopefully that's all okay. If you've got any questions, please do fire them through. But has that been useful? Give us a quick yes or no in the questions box. Forexfactory.com is pretty useful. There's a countdown to FOMC link that you just search for countdown to FOMC. You can see when interest rates announcements are coming through and how likely they are to raise or cut rates. They can be very, very useful. The Monday workshops, no, the one in the morning, Andrew. So 8 in the morning, usually to about 9:15, something like that. Have a look at that. So that's when we talk about some of the fundamentals that can be important. One of the things I wanted to cover off on today is something a little bit new, though. I'm going to be finishing in just 2 seconds. But what I'd say to you is, if you're a Trendsignal Plus Trendsignal member already, fantastic. Great. Hopefully this has been a very useful session. If you're not a Trendsignal member already, then a couple of things. Number one, get in touch with us because we do provide systems, tools, strategies that could help you with your trading as well. And there's some contact details there. If you want to put your phone number into the questions box, I can arrange one of the team to give you a call and talk to you about the various courses and systems that we provide traders with to help them to trade with more confidence from home. One of the things that we are doing next week, so the 26th of January, is we're hosting something new for us. We've never done it before. We're calling it the 2023 Online Trading Summit. What it is it's a full day of trading education. Now I'm going to share the link with you, so don't go yet. I'm going to share the link with you on the chat, and you can see the short link there, so you can type that into the questions box if you want to. Bear with me. I'm just going to post this into the chat here. Now, I know this landing page isn't quite ready yet, but you can literally copy and paste that link there. So bit.ly/3h bloody bloody blah. If you go to that page, visit that page, I've put it in the chat, you can copy and paste it from there. What this is a full day training event that we're running on the 26th of January. I'm going to go through a little bit about what that involves here. This is the page that it brings up, and a rather attractive man there. I don't like that picture of me, I look ridiculous. But anyway, watch the video, tell you a little bit more about it. But it's a whole day event that we're running. It's going to be free to attend, and we're going to go through loads of beginner and more experienced trader education from 8 o'clock in the morning on the 26th of January right through to 5:30 in the evening. We've got 16 different live events. It's running at 9.5 hours of trading education, going through various different topics. Now, if you get to this page, then what you can do is you can scroll down and you can see the agenda here. So all the different schedule, for example, me and myself, Jerry, are running through the first session from 8 o'clock, the essentials of trading, good beginner session there, technical analysis, fundamental analysis, how to make money using trader sentiment. I'm doing that one. And there's various sessions we're doing, talking about some live trading, all the sort of stuff that's really going to help you as a trader, whether you're brand new to this, whether experienced. Like I said, it's free to attend, and we're going to run through. You can attend as many or as few of these sessions as you like. All you need to do is find your way to that page. And if you don't know where to go, the link's on there, or just pop an email through to the email address I'm going to send through now, which is info@trend-signal.com. So if you just pop an email through, we can send the link there. But all of these events you would have access to. You can attend all of them, you can attend none of them, one of them, whatever it is. But the thing to do is to go to that page, register your details and then you'll get access, some free information and so on about how to access that and launch the session. So that is the 26th of January. 16 individual sessions. You can just log into one and then you'll be able to stay in the whole session. So it's one sort of uber massive webinar. And we'll be changing the schedule as we go through, running through each different event through all of our speakers here at Trendsignal as well. I think it's going to be a great day. I'm really excited about it. Lots of really good content. Watch this video, tell you a bit more about what we're doing here and so on. Otherwise, everybody, that's pretty much it for me. I'm going to call it an end to today's session. I look forward to hopefully seeing some of you online on that session as well. And bye-bye for now.